Welcome to the SOP Advisors webinar. What is driving the gold, copper, and energy markets? My name is Steve Allen. I'm the Managing Director and Portfolio Manager at SOP Advisors. Joining me on the webinar is Darren Geiger, an advisor to the firm and someone with decades of energy and commodity experience. This webinar is the second in the series, of all of which support our thesis that hard assets will outperform paper assets in the coming years. In short, stuff will outperform paper. In fact, it's in our name, SOP, stuff over paper. Our inaugural webinar lays out the reasoning and our thesis on some of the secular shifts that will be occurring that will support allocating a significant portion of your portfolio towards hard assets in the coming futures. You can look at access that webinar through our YouTube channel, but also on our website, and the information is provided here. In fact, stuff is starting to outperform as we see it today. This is a chart showing the breakout of what's happened to some of the top commodities are breaking out of their 3-year averages, and that percentage that are breaking out is something we haven't seen in over 5 years. So stuff's starting to outperform. It's also starting to see it be picked up by the media as well. This is just a chart showing that the number of mentions that hard assets is getting in the media, and you're seeing that numbers is starting to spike. We're also seeing some of the ancillary topics associated with hard assets and stuff. This is termed debasement, and it's the amount of views that it's getting in the media and how it's being picked up in the media. And you see that spike that occurs around the time that gold is getting on investors' radar screens. And part of the reason is just the performance of some of these metals. This is a chart showing the performance of some of the other precious metals outside of gold. In fact, gold has been the weakest performer. Here we see, in fact, that silver has more than doubled. Platinum's is doubled this year, and the laggard has been palladium, which is only up around 76%. So again, gold's been the laggard this year, but gold's been done very well in terms in fact, it's been the second best performance on record. Um, some of the reasons for this substantial run during the year are what we term debasement, de-dollarization, and diversification. This just chart showing what the debasement looks like. This is the amount of gold that it takes to buy $1 unit. And you can see that this has fallen by 80% since 2009. Or in other words, in more basic terms, the dollar has lost 80% of its purchasing power in gold terms since 2009. So investors are starting to express their concerns over this persistent inflation and runaway government spending through their purchase of gold. De-dollarization is one of the other driving factors for gold's outperformance this year. And we talked about that in our original webinar. Some of the impetus behind de-dollarization originally took place after the Ukraine invasion, where there was large seizure of private assets, and large dollar holders, particularly the Saudis and the Chinese, were quick to pick up on this, and this made large dollar holders nervous. So we saw them divesting a lot of their treasury holdings and recycling those dollars into gold. And that continues this year. And this just shows a chart of some of the largest central bank buyers, China only being the fifth largest this year. But some of that buying might be done rather covertly. And this is a chart just showing some of the central bank buying might be being done covertly to stay off of the Trump administration's radar. And lastly, gold has been has been bought for a diversifying agent. This is a chart showing the performance of capital markets around the times of the Independence Day or Liberation Day, excuse me, and as you could see that gold did what it was supposed to do. As you can see that sharp sharp sell-off in the Nasdaq and Bitcoin and gold staying steady and actually outperforming quite substantially. So gold did what it needed to do. In fact, it shouldn't be too surprising. This is a chart that we from our last webinar, which shows the correlation uh, between certain asset classes and large cap growth, aka the Mag 7. As you can see, commodities are the single best diversifying asset against large cap growth against the Mag 7. Gold being the second to best, T-bills being only outperforming gold. So gold did performed exactly as it did, as it should have. One thing that was really interesting during 2025 was that gold didn't respond to many of the metrics that it normally did. And normally, it would when real rates rose, gold still continued to go higher. When the dollar rose, gold continued to go higher. Those are not typically what we would normally see. The one thing that was consistent throughout the year was that gold moved uh, lockstep with uncertainty. And this is just a chart showing kind of the uncertainty index mapped against the price of gold. And as you can see that those gold continued to go higher as the market tried to deal with uncertainty. And there was a lot of uncertainty during the year, obviously with tariffs, uncertain monetary policy, uncertain foreign policy, and buyers continue to flock to gold to protect themselves. The gold is not the only metal that had a great year in 2025. Copper was up 32% year to date. This is a chart of the copper gold ratio, and I just put this up here because historically the copper gold ratio has been a good predictor of future recessions. And as you can see, if we go back to 07, 08, when that line dropped precipitously, that was a good harbinger of the future recession. And excuse me, and the weakness in 27, 2018, the same thing. So excuse me. So I think, but over the last 5 years, that ratio has continued to fall, and it's not has not been a good predictor of recessions of late. And the reason that we believe that is because that ratio is operating on different fundamentals that are associated with each different metal. This is just a chart showing that copper is outperforming is beating all the other base metals. The only other metal that's close is aluminum, but lead and zinc and the others have significantly lagged. And the reasons that we believe that copper has had such a good year are what we call tariffs and tumult. Copper initially avoided the Section 232 tariffs associated with steel and aluminum. However, the market was anticipating that those tariffs may be imposed later on, and they were. And this chart just shows the premium of the COMEX LME or the COMEX copper contract over the LME copper contract. And as you can see, the market started to anticipate um, that tariffs might come into place, and they bid up that premium. And in fact, the Trump administration did place tariffs on copper, or 50% tariffs on copper around early July. However, after several weeks, the Trump administration began to understand that we're not self-sufficient in copper, and they removed those tariffs. And this chart just shows that premium coming out, that premium of the COMEX over the LME coming out and dropping precipitously along with the price. However, that didn't last very long. As you can see, that spread. This is again that spread over the COMEX over the LME. And as you can see, that spread narrowed slightly going into the spring, but it's continued to widen up. And it's showing that the U.S. is now the marginal buyer of copper, and no longer is China the driving force behind price. And this just shows it even more emphatically. Here's the movement of metal back to the U.S. And so this movement of metal is coming back to the U.S. With the understanding that either tariffs might be reimposed, or the U.S. will find some way to ring fence supplies of copper. And some of the other concerns that have driven the price this year is of what we call tumult, and that's really just due to what's happened on the production side. And this chart shows some of the disruptions that we've seen over the course of the year, and these are all due to outages in Indonesia, in the DRC, and also some rationalization of production in Chile. And they all added up to some concerns and some disruptions on the supply side. Most importantly, the Freeport-McMoRan mine in Indonesia represents 3% of total global supply, and it's understood that mine won't be back up to full capacity until 2028. So this slide just shows you how concentrated the copper market is. It's basically, Chile, the DRC, Peru, China, the U.S. coming in fifth, but not only concentrated by country, but also concentrated by mine. So given what's happened on the supply side, against strong demand, it's anticipated that the market will go into deficit sometime in 2027 or 2028. And this just shows you, what might happen with AI as an additional demand driver. As you can see, not a huge demand driver, but again, the market balance is very will fall into deficit sometime, clearly fall into balance sometime clearly in 2027, even without AI. This is a chart just from our original webinar that shows how long it takes to bring a greenfield mine into production, and the U.S. is one of the most challenging. It takes around 28 years to bring a mine from greenfield into full production. So obviously that's not going to solve our issues on the supply side. In fact, that Resolution mine in Arizona, which is a massive copper deposit, it already has had production at some point. Bringing that back into production, they estimate will take anywhere from 8 to 10 years. So obviously, new production is not going to bring the market back into balance. So we're very, very bullish on copper based on the fundamental supply demand picture. But with that, I'm going to turn it over to Darren. He can tell us what happened and what is happening on the energy side.
Thanks, Steve. The energy markets heading into 2026, we're heading into the year with a bearish tilt for liquids, structurally firmer pricing for natural gas, and tight regional power balances shaped by LNG, renewables build out, and data center load. So taken together, these markets are wrestling with ample global oil supply and the evolution toward the start of a more structural CapEx constrained gas and power centric cycle. The slide that you see now is the futures curve for both Brent and WTI crude oil. And it's pointing to overall softer pricing, especially in 2026, where the curve is materially backwardated. Focusing on the WTI curve, it peaks and plateaus about 5 to 8 years out at $62 per barrel. So clearly, oil is no longer the main energy-related inflation shock risk. Curves are telling you to expect range-bound prices with more volatility around geopolitics rather than structural scarcity. And demand really isn't the issue. It's a supply-led story. Most forecasts for 2026 show global liquid supply growth outpacing demand, driven by unwinding of OPEC plus cuts and resilient non-OPEC growth out of the US and Guyana. On the next chart, for 2026, we have the likes of the IEA on the bearish side and OPEC on the less bearish side of 2026 overall demand. And I suppose the point to make here is essentially no one is overly bullish, especially next year. And as this chart shows, the demand estimates for 2026 are between 104.6 and 106.5 million barrels per day. So there's almost a 2 million barrel divide between the IEA and OPEC with regard to oil demand next year. And this is the widest gap for more than 2 decades between the forecasts of the 3 main international organizations that track the world's crude markets. Interestingly, on the next slide, where you see similarities is in the long-term forecasts out in 2050. You see virtually the same amount of daily crude demand forecast from OPEC on the left at 112.4 million barrels per day, and the IEA on the right, which is right at about 113 million barrels per day. And from the IEA's perspective, it's a massive change from their outlook just a few years back. And this reinforces our view that the IEA may be too low on the demand side for next year. On this next slide, we show US oil production, which is the most impactful non-OPEC plus global supplier. And we anticipate that US growth to plateau next year with a value over volume mindset. We feel producers will prioritize returns with these weaker prices, even as the Permian productivity remains fairly robust, and we add some long cycle barrels out of the Gulf of Mexico. We also anticipate consolidation will lead to more production in the hands of the strongest domestic E&Ps who have the balance sheet to throttle back production when and if it makes sense. On this next slide, it shows the break-even prices for major basins in the U.S., and this is based on responses by operators in those respective basins and published by the Dallas Fed. One basin that isn't listed individually is the Bakken Shale, which is located primarily in North Dakota and has production at about 1.3 million barrels per day. And this is the swing basin in the U.S. on price and would likely be the first to exhibit somewhat of a production decline with prices any lower than the high 50s, high to mid 50s. And we've already heard a few reports of E&Ps cutting production up in the Bakken. This next slide, this is where oil price estimates are for 2026 and come in from respondents in their capital planning. As you can see, most price estimates for next year by respondents reside somewhere in the 60 to 65 per barrel range. So again, quite a bit more optimistic than the futures curve depicts. For us, when we look out to 2026, what could surprise on the upside in terms of price? Clearly, as we talked about a little bit earlier, the geopolitical impacts. Venezuela has become front and center with essentially a blockade of their exports. They produce about 1 million barrels per day and export about 800,000 barrels of that. So the U.S. has already seized one tanker. And we think this is somewhat bearish for Western Canadian select prices up in Canada, which is most similar to the heavy barrels that are coming out of Venezuela, because those barrels that were captured on that tanker are being sold at significant discounts. We also think, like, where prices currently sit, this gives the U.S. administration somewhat room to act unilaterally without much risk to prices going too much higher. A couple other potential upside risks to price. Russian supply drops more sharply than anticipated as attacks continue targeting their energy infrastructure, which we've seen on a daily basis, as well as their tankers. And finally, U.S. production pauses and or reverses as higher prices are needed to justify that added production. On the downside, again, which a lot of analysts are kind of leaning towards, U.S. production could remain resilient, even growing in this subdued price environment. Or there's recessions amongst larger economies, most notably the U.S. and or China. So kind of moving away from crude oil into more, say, exciting energy news, we'll start focusing on gas and power. This slide that you see now depicts gas demand over the last 4 years, with 2025 easily eclipsing the prior 3. Gas was trading at a 3-year high of over 5 per MCF just a few weeks ago before retreating back under 4 more recently. In the US, we've exited injection season with storage ahead of pace, currently at about 3.6 TCF. So despite this record demand that you see, prices are lagging due to ample supply. The next slide, we focus on LNG. And fundamentals are tightening into an LNG structural demand data center cycle. And if you look at these two LNG charts, LNG exports on the left continue to print records and are projected to step up to roughly 16 to 18 BCF per day by 2026 as these new facilities, as detailed on the right, ramp up, pulling U.S. balances tighter and keeping overall inventories somewhat balanced. Moving into power on this next slide. Power demand is somewhat of the most discussed energy topic at present. But while electricity prices have risen materially, which you can see on the chart on the left, it isn't really reflected in the gas futures curve. There's a reason. This is large. There's a large disconnect between AI power demand forecasts and the positions power traders are actually willing to put on. In addition, of late, we've seen a cooling of the AI story, especially in terms of deals announced versus ultimately what's real. On the right of this slide, you can see where Rystad's estimate of where power demand will come from over the next 10 years. Data centers, while material, is fourth on the list. And I guess the overall overriding point is that global power demand is expected to rise 30% over the next decade. But when it comes to electricity prices, the culprit is primarily grid upgrades. AI data center demand will increasingly speed that process up, but it's ultimately a question of who's going to pay for these upgrades and expansion. And we've seen in press reports recent elections and price impacted areas highlighting electricity prices, how high they've risen, and the need to drive them lower for residents. And since power is in somewhat of this newfound growth phase, we're seeing a lot of pivoting to power exposure from those super majors and even several midstream companies. This next chart kind of depicts how commodities performed in 2025. And the reason there's a disparity is because of the makeup of these respective indices. So it really depends on the index and more specifically, the weightings in each index. So the Bloomberg Commodity Index, the BCOM index, outperformed the GSCI because it was 34% allocated to metals at the beginning of the year and 30% to energy, whereas the GSCI was 17% metals and 57% energy at the start of 2025. So it's important, I guess the point is it's important to look at these weightings when assessing the commodities markets, especially for these more general indices. On this next slide, this is an example of why someone needs to tune out noise and narratives and focus on fundamentals. Chart on the left shows how solar has performed relative to the XLE, which is an ETF made up of upstream oil and gas companies. And renewables are excelling because they're often cheap, fast, behind the meter. And we've seen the same response, as you can see on the chart on the right, to battery cell storage firms, with the amount of battery storage capacity that's been added to the grid, which has just skyrocketed over the past 3 to 4 years. So in summary, we're not overly bullish, say crude oil for 2026. However, from our point of view, it appears market participants are just a bit too bearish leaning. We expect more consolidation, as we said before, as lower prices increase the attractiveness of adding quality assets. And that said, we like certain other pockets of the energy complex in varying degrees. The risk-return dynamics in many areas look quite favorable. And we're definitely seeing more commodity, as Steve has pointed out in a number of his slides, a number of commodity bullish stories for 2026 coming out as investors look around at what's cheap, often constrained, and provides inflation and dollar protection. And as Steve also mentioned, SOP is completely on board with that, and that's our general thesis. So with that, I'll kick it back to Steve to wrap up.
Thanks, Darren. we firmly believe that 2025 marked an important point in the transition towards hard assets. We think that this is definitely represents an end to the underperformance, the relative underperformance that's existed for decades. As you can see here, this chart right here just shows the BCom precious metals index relative to the S&P equal weighted index. As you can see, it's finally hooking up there at the end. So we definitely believe that we're at the early stages of this relative shift in valuations. This is another slide showing that stuff is literally beating paper. This chart shows the total return on the commodity, the BCom index versus the total return on the 10-year Treasury. And as you can see, the stuff is literally beating paper. So that we do believe that this transition is occurring, and in many of the secular shifts and cyclical shifts that we described and talked about in our first webinar are strengthening and further pushing this relative valuation in favor of hard assets. Please stay tuned for our next webinar titled "Stockpiling Hard Assets in Your Portfolio in 2026." Here we will talk specifically about certain sectors and certain names that we like. SOP Advisors has over 50 years a combined experience in real assets and commodity-related equities. We build actively managed specialized portfolios utilizing equities and ETFs. This gives you investors full transparency and liquidity on Schwab and other platforms. So stay tuned. Thanks for listening. Stay tuned to our next webinar, and we'll be speaking to you soon.